I am going to now go over the McGraw-Hill homework, and there is no doubt this is a tough week. I cannot lie. This has been a tough week, and so hopefully having this YouTube, because I'm recording these, so everyone will be able to have access. Now, I know you see Emily's name. She gave me permission to use her problems, so I don't want there to be any conflict of student privacy. So Emily, I hope that was okay. They saw your name right there. But we're going to start with problem 2. And everyone's got the same type of homework, exact same. The only thing is the numbers are different. So if you watch me go through Emily's, you're going to have pretty much the same homework problems. So problem 2 says, convert cash basis accounting to accrual basis accounting. Minuteman Law Services maintains its books using the cash basis of accounting. However, the company decides to borrow money from a bank and they want financial statements prepared using the accrual basis of accounting. So we have to take this information they gave us to decide how do we take this information and make it work with accrual basis of accounting. So it can be confusing because it's like, wow, you're giving me cash, you're telling me these accounts receivable, what the heck? Well, if you think about it, accrual basis of accounting is monies that have been earned. So the main thing and the trick here is on January 1st of 2018, the accounts receivable was sitting at $20,300, which means they were due money coming in of $20,300. On December 31st, the accounts receivable balance is at $22,600. And what that means is the $20,300 was monies that were earned the previous year but still haven't, or revenues that were earned the previous year but they still haven't gotten the cash on it. Well, throughout the year they did get the cash. Now at the end of this year we have what's due the company $22,600. So an easy way to look at this is to say what we need to show as revenue is the $22,600 plus the $63,000 in cash minus the $20,300 gives us our accrual basis of revenue of $65,300. Now the way this McGraw-Hill shows it is the accounts receivable increased $2,300. So it went from $20,300 to $22,600, which is a $2,300 increase. So what they're doing is $63,000 cash plus the $2,300 increase gives you the $65,300 also. So what I was doing is basically saying the accrual basis is the $22,600 plus the cash of $63,000 minus, we can subtract out the receivables from the year before. They're kind of cutting through a step and just saying, how much did these increase? We take the cash plus this increase, that is then the accrual basis of the revenue. For salaries expense, we're going to kind of do the same thing. You see, they paid out salaries of $35,300. The salaries payable during the year went from $2,350 to $3,700. So it went up an extra $1,350. So we could take the $35,300 in salaries plus what it increased of $1,350 to show our salaries expense on accrual basis should be $36,650. Another way to look at this is you take the salaries of $35,300 plus the salaries payable of $3,700, because remember, the salaries expense isn't what just you paid, it's what has been incurred. So at the end of the year, they must have had $3,700 of salaries that they debited salaries expense, they credited salaries payable, but we haven't paid the bill yet. So if we take the $3,700 plus the salaries that we've paid out of $35,300, subtract our salaries payable from the year before, or from the beginning of the period, we're going to come up with the same $36,650. Now, supplies expense, we paid cash for supplies of $3,300 plus our $2,650 of a decrease in supplies. So let me show you what we're talking about. Do you see on January 1st, our supplies were $4,300. On December 31st, our supplies are $1,650. That means when we went to do a count on hand, the beginning of the year we had $4,300, at the end of the year we have $1,650. Now we purchased in supplies throughout the year $3,300, but we also need to add the decrease in supplies. So because we went from $4,300 to $1,650, that means we used up a lot more supplies than just this $3,300 here. So the difference between the $4,300 and the $1,650 gives us $2,650. So the cash plus that extra amount we used up, the $5,950, would be our supplies expense. Our rent expense is going to be done the same way. We paid out in rent $4,300, but our prepaid, $4,300 is it, because we don't have any prepaids here. So $4,300 is the same as a cash basis. We keep it the same. Our insurance expense is going to be similar to what we did with supplies. Our insurance we paid $6,300 for. But then look at this. Our prepaid insurance was $0 at the beginning of the year. Now it's gone up to $3,350, which means some of the $6,300 of insurance was for insurance paid in future years, which we're not going to write off as insurance expense this year because it's for future years. So if we take the $6,300 and minus the $3,350, because what that tells me is some of that $6,300 was in this prepaid insurance. $6,300 minus the $3,350 gives us what our real insurance expense is of $2,950. Then utilities expense, we paid out in cash utilities of $2,300. We don't have any prepaid utilities here, so $2,300 is going to be representative of what our accrual basis would be also. So we've got our service revenue minus our various expenses gives us our net income on the accrual basis of $13,150, which you've got there. I think that's everything for that problem. Do you have any questions on that, Emily? I'm happy to go over anything to reiterate, to explain in a greater detail how I came up with those numbers. I'm waiting for you to type. I see you typing. What is the salaries expense? Okay, so the salaries expense, maybe I didn't go over that. I'm sorry. So the salaries expense, yeah, I did, of $35,300 here is what was paid out in cash. But the salaries expense of $35,300 plus the 3,700 minus the 2,350 means our salaries expense would be 36,650. Yeah, instead it's not 36,500, it's 36,650. So it's basically the cash of 35,300 plus the difference of $1,350 was an increase in salaries payable. 36,650, not 36,500, if that makes sense. Okay, let's move on to the next problem. The next problem, and I just need to reiterate, Emily has given me permission to use her McGraw-Hill, so I don't want anyone feeling like I'm exposing Emily to anything because she's given me permission. This next one is going to go through various journal entries. So, the information necessary for preparing the 2018 year-end adjusting entries for Gamecock Advertising Agency appears below. Gamecock's fiscal year-end is December 31st. So what we're going to do here is we're going to go through each one of these and describe the journal entry. Now, I see a couple more people are on, and this will be the same journal entry for you. The numbers might be different. And so, Elena, if you have questions, you can type in and I can work with you also. But it's going to be similar journal entries. Our numbers may be different. A says on July 1st, 2018, Gamecock Revenue receives $5,700 from a customer for advertising services to be given evenly over the next 10 months. Gamecock credits deferred revenue. So on July 18th, Gamecock receives $5,700 from a customer for advertising services to be given evenly over the next 10 months. So think about this. That was on July 1st, 6 months ago. It's December 31st. So if we took our $5,700 divided by 10 months is $570 a month. Okay? We've used up 6 months of advertising services. And that $5,700 was going to be good for 10 months. So 570 times 6 months, should be the $3,420. I'm going to just pull up in an Excel because I don't have a calculator on me, which I should. Any accountant should have a calculator. I guess I have it on my phone, but I just don't know how to do that. But this doesn't hurt for us to go this route. So $570 times 6 months equals $3,420. Did I do something wrong? $3,420. That's the amount. So basically what we're going to do is when we did this back on July 1st, we debited cash of $5,700. We credited deferred revenue of $5,700. Now that it's at the end of the year, we've used up, we've gotten some of these revenues just because of the passage of time over 10 months period. We've used up 6 months, or we've earned 6 months of those 10 months. So we're going to reduce our deferred revenues and we are going to be crediting service revenue. So those that might have a different figure, you're going to still do it the same way. So if you've got $10,000, say, and Gamecock received $10,000 from a customer for services to be given over the next 10 months. Again, remember that happened on July 1st. 6 months have passed. So we would then take 6 months of that money, or $6,000 if they in fact gave us $10,000, and we would debit the deferred revenue for the amount that we have now earned, and we would credit our service revenue for the same amount. Now, Elena, if your numbers, do you have the same amount of months, or did they change the months on you too, or was it just the amount that was changed? Okay, great. So now next, at the beginning of the year, Gamecock's depreciable equipment has a cost of $26,000, a 4-year life, and no salvage value. The equipment is depreciated evenly over 4 years. So we know our accounts are going to be a debit to depreciation expense, a credit to accumulated depreciation. $26,800 is the amount. $26,800 over 4 years. So what we would want to do is our $26,800 divided by 4 years would give us a depreciation of $6,700 each year. So we debit our depreciation expense, $6,700, and we credit our accumulated depreciation, $6,700. Next, C, on May 1st, 2018, the company pays $4,440 for a 2-year fire and liability insurance policy and debits prepaid insurance. Okay, May 1st they did this. We're at December 31st right now. That means 8 months have gone by just with the passage of time. This has become an insurance expense. So $4,440, it's 8 months, and the policy is a 2-year. It's a 24-month policy. So if we take, now I forgot the amount. The amount is $4,440. So $4,440 over 24 months. So if we take the $4,440, divide that by 24 months, we get $185 a month. $185 a month times 8 months gives us insurance expense of $1,480. So we debit our insurance expense of $1,480, and we credit our prepaid insurance of $1,480. Now, excuse me. Emily, you're asking on the depreciation, why is it $6,700? Because if we take the depreciation, the cost was $26,800, and it has a 4-year life. So that means we depreciate 1/4 of it each year. $26,800 divided by 4 gives you $6,700. And then why is it $1,480? As you look here, our insurance was $4,440 for a 2-year policy. A 2-year policy means 24 months. So if we take the $4,440, divide that by 24 months, it means our insurance is $185 a month. We took this out on May 1st of this year, which means May, June, July, August, September, October, November, December. We've gone through 8 months of insurance. $185 times 8 months of insurance means that we have gone through $1,480 of insurance. Does that make sense? I hope that helps. Okay, let me go back here. Now, next, interest expense. On September 1st of 2018, the company borrows $17,000 from a local bank and signs a note. Principal and interest at 9% will be paid on August 31st, 2019. So they have taken out a 1-year note. All we care about is calculating what we owe in interest up till the end of the year, which is December. So they took this note out on September 1st. September, October, November, December, that means 4 months of interest. Okay? 4 months of interest. We need to calculate $17,000 at a 9% interest rate. So we're going to say $17,000 at a 9% interest rate. Okay? Interest rates are always calculated annually. So 17,000 times a 9% interest rate means the interest for a year is $1,530. Okay? Now we know a year has 12 months in it, which means the interest per month is $127.50. We took out this note September 1st, which means there are 4 months in this year that we had to accrue interest. So $127.50 per month times 4 months of interest for this year means we need to accrue interest of $510. So we debit our interest expense for $510 and we credit interest payable for $510. Now remember, we didn't pay it. We're not going to pay this interest until next August. But what we care about is having accurate financial statements that show the big picture. The real picture is we do owe this interest. This interest did in fact occur in this year, so we want to record it appropriately and show that the interest for this year is accurately stated. If we didn't do that, then our interest the next year is going to be overstated, which basically means we would show less net income the next year and more income this year because we didn't accurately show an expense. Now, the last one says at year end there is a $2,550 debit balance in the supplies account, but only $970 of supplies remain on hand. So $2,550 is what it shows, but when someone takes a physical count, it's only $970. So if we go here and show $2,550 is what we show in our books, but $970 is what it really was. So really what we're doing here, oh, come on. So really, really what we're doing here is, if 2550 is what it shows, but 950 is really what's there, the difference, 2550 minus 970, or 1580, is what we should show as a supplies expense. So we debit our supplies expense of 1580. We credit our supplies because that's an asset, but our asset has gone down, so we don't want to show we have more supplies than we really do. So we have to reduce our supplies accordingly. Does that make sense? Now, Elena, you, I think, wanted to do problem 4. I think you said 4. So let's move on to question 4. And this here shows us, for question D, I'm going to just go through them all, because I'm going to post these to a YouTube account so everyone can look at it. So this is recording adjusting entries. Crimson Tide Music Academy offers lessons in playing a wide range of musical instruments. The unadjusted trial balance as of December 31st appears below. So then what it tells us is all these different changes. So, for example, the information necessary to prepare the year-end adjusting entries are below. Depreciation of equipment for the year is $4,900. All we need to do with that one is debit our depreciation of $4,900, credit accumulated depreciation of $4,900. B, accrued salaries for the year should be $1,550, so we debit salaries expense, credit salaries payable, $1,550. Interest expense, Crimson borrows $14,500 on September 1st. The principal is due to be repaid in 4 years. Interest is payable each August 31st. Again, we don't care about all that. We just want to know, what is the interest expense for this year? If we took out the loan on September 1st, that means we have 4 months of interest. Our $14,500 times 9% gives us our interest amount for the year. If we divide that by 12 months, we get the interest each month. We multiply that times 4 is when we would get our interest expense of $435. I'm going to just do that real quick so it's real clear. 14.59%. So if I take 14,500, so I'm going to just do this, equals 14.5 times 9%, it gives me 1305 for a year. If I take that and divide it by 12 months, that means my interest expense is $108.75 per month. If I take 108.75 times 4 months, because remember, September, October, November, and December gives me $435, and that's my interest expense from September through December. D, unused supplies at year end total $590. Crimson Tide debits supplies at the time supplies are purchased. So let's see what's going on here. So right now we show supplies of $1,450. So if supplies here show $1,450, but at the end of the year they're only showing $590 sitting in the closet, that means the difference, or $860, was used up. So when supplies get purchased, we always debit supplies, we credit cash or accounts payable. At the end of the year, we create this adjusting entry to say, okay, how much did we really use? So we go and we take the asset, supplies, 1450 minus what it's telling us got used up of 590. The difference, the 860, is the expense. We reduce our supplies so we accurately reflect the new supplies balance. Next, rent expense. Crimson Tide opens a second studio by paying for 1 year of rent in advance on April 1st for $58.80, debiting prepaid rent. So they took a year's prepaid rent, but think about it. 9 months have gone by since they paid that. So they put it all into prepaid rent, $490 a month. So initially, $58.80, let me just do this. So they put $5,880 for a 12-month's rent. They did it April 1st, which means 9 months have gone by because today's December 31st. So $58.80 divided by 12 months is $490 a month. $490 a month times 9 months that have gone by is $4,410. So don't you see how we need to show a rent expense of $4,410 because just due to the passage of time, this rent is used up. And then we're going to reduce our prepaid rent by $4,410 because we don't have that anymore. We've used it up. Next, the last one just says unpaid utilities is $300. We show utility expense of $300. We credit utilities payable of $300. Next, number 5, Boilermaker Unlimited specializes in building new homes and remodeling existing homes. Remodeling projects include adding game rooms, changing kitchen cabinets and countertops, and updating bathrooms. Below is the year-end adjusted trial balance of Boilermaker. So this is giving us the adjusted balance. What they want us to do is to prepare an income statement. Remember, our income statement begins with revenues. It ends with expenses. These are our income statement items. Revenues and expenses. We are going to prepare an income statement based on only these figures. So if we move down here, we've got 2 revenues, new construction and modeling, gives us our total revenues. Then we take all of our expenses. We don't have to do anything goofy here. We just literally copy them from our trial balance. And we come up with net income here of $36,400. Then it's going to want us to prepare a statement of stockholders' equity. The most important thing to know is our common stock of 105, our retained earnings of 25.9 are our beginning balances. So that's the first thing we do is we put in our beginning balance of common stock, our beginning balance of retained earnings to give us our stockholders' equity. Okay? We also know our net income from our income statement is going to be added here to retained earnings. We don't calculate common stock. Our common stock, if you look here, this is our adjusted trial balance. Do you see it said common stock of 105? this is our, as of December 31st, 2018, 105. What has happened is 105 is the 94 plus 11,000. They're telling you here, prepare the stockholders statement of stockholders' equity for the year ended 2031. Note that during the year the company issued additional common stock of 11. So what they're trying to make you realize is, oops, issuance of common stock of 11 has to go in here, right here, 11. So we know if this happened during the year, then our adjusted balance of common stock is because we added something new during the year. So 105 is now our ending balance. To subtract 11 out of, because it got issued during the year, we had to begin the year with 94,000. If common stock didn't change at all during the year, then the beginning balance and the ending balance are going to be the same. But they're kind of adding this little extra piece in here to let you know they did issue some more shares of 11. And that's to make you know I've got to put that 11,000 in up here. Now, our retained earnings we gather here. We add our net income, but the one piece we have to look at is we have to go and see were there any dividends paid, and there were. There were dividends of 24,100 paid. So we have to go down here, subtract that 24,100 to come up with an ending retained earnings balance of 38,200. So our 105 plus our 38,200 gives us our stockholders' equity here of 143,200. Now to do our balance sheet, we are going to take 105, the 38,200, and that gives us our stockholders' equity. You see here 105 and the 38,200 and our ending balance of 143,200. We just pulled that from there. Okay? Now the rest of the balance sheet is going to come from this adjusted trial balance. The rest of the balance sheet is going to, all of this is going to be the same. Cash, accounts receivable, supplies, prepaid insurance, equipment. Remember, accumulated depreciation goes under assets as a contra account for that equipment. We're going to use all that. We don't need to worry about common stock, retained earnings, and dividends because look, we got that right here. So we go down here to create our balance sheet. Our cash, accounts receivable, supplies, and prepaid insurance gives us our total current assets. Then our long-term assets are equipment minus accumulated depreciation. Our total assets are at 341,500. We put in our payables, current liabilities, and then our long-term liabilities. Our stockholders' equity, everything's going to balance just perfectly. I need to slow down. I'm so sorry. Let me do this again. So, let me go back here. Emily, are you stuck on the balance sheet or should I go back to stockholders' equity? Okay. So, okay, 1 second here, guys. Okay, sorry about that. I just was responding to some emails. I'm trying to figure out the total stockholders' equity. No problem. Let's go back. We figured out our income statement. The $36,400 in the income statement, ultimately in net income, we're going to add that to our retained earnings. To add to our retained earnings, the dividends of minus $24,100 shows up on our adjusted trial balance here, the 24-1. So we know the retained earnings piece is our beginning retained earnings balance plus our net income minus our dividends to give us our ending balance. Where they're trying to challenge you a little is you see here common stock of 105. So normally common stock doesn't change from the beginning of the year to the end of the year. They're telling us that the 105, it says here, prepare the statement of stockholders' equity for the year. Note that during the year, the company issued additional common stock for $11,000. So we have to take into account that that 105 includes that $11,000 we need to report here. So the way we figure that is we back in the beginning balance. Okay, so again, guys, once we figure out the statement of stockholders' equity, which has an ending balance here of common stock of 105, retained earnings of 38.2, with a total stockholders' equity of 143.2. We can put that right down here in the stockholders' equity section of the balance sheet. This is why we generally compute a stockholders' equity section statement and then use that to fill in that portion of the balance sheet. Everything else related to this balance sheet comes from our trial balance up here. Everything. Now remember, the revenue and expenses are only on the income statement. We don't mess with that on a balance sheet. We don't mess with dividends either, because that's part of our stockholders' equity. Our common stock and retained earnings is also part of our stockholders' equity. We're deriving those numbers. But every single thing else we can use for our balance sheet. So our balance sheet is taken from our trial balance. The aspects of the stockholders' equity section comes from our statement of stockholders' equity. And our assets will always equal our liabilities of 198.3 plus our stockholders' equity of 143.2. Equipment has a useful life and provides a future benefit for more than just this year. So it's always an asset. And one thing we learned this week is that this accumulated depreciation is what we call a contra asset against that equipment or whatever asset we're depreciating. So you have to lump the two together, the equipment less whatever accumulated depreciation is there, to come up with the net asset of those assets that have not yet been depreciated. So as we move on to the next one, we're going to go to questions 6 and 7. What do you need on 5M? What with 5 can I work with you on? So the balance sheet is merely the figures coming from the adjusted trial balance over here. Cash of $14,100, accounts receivable of $25,900, supplies of $32,900. You see how I'm getting all those here. $14,100, $25,900, $32,900. The prepaid insurance gives us our total current assets. We take our equipment of $387,500, which you see here. $387,500. You have to make sure this accumulated depreciation offsets your equipment. So our $387,500 minus our $124,000 gives us our total assets of $341,500. So everything came from the balance, the adjusted trial balance. Just remember, our equipment needs to be offset with our accumulated depreciation of $124,000 minus $124,000. Our accounts payable, salaries payable, utilities payable, and notes payable came from up here. Accounts payable, salaries payable, utilities payable, and notes payable. All of that, all of this section right here are our liabilities. So we put those liabilities in, as you see down here. They are separating out total current liabilities from long-term liabilities. Then, as we talked about, your statement of stockholders' equity, the statement we just did, gives you the ending balance of the common stock, ending balance of retained earnings, for a total balance of stockholders' equity of $143,200. We put that in here, and again, our assets will always equal our liabilities plus our stockholders' equity. Now let's move on to number 6 and 7. We are going to record closing entries. So basically what we're going to do here is look at this post-closing trial balance, and we've got some information. The following information replies: the year-end financial statements are below: income statement, balance sheet, stockholders' equity, and they want us to record the closing balances. So basically, if you look at the income statement, don't we know that all of those accounts must be zeroed out? Revenue and expense accounts are always temporary accounts. The dividends account is always a temporary account. Revenues have a normal credit balance, so to close them out, we're going to have to debit them. Expense accounts have a normal debit balance, so to close them out, we're going to need to credit them. Dividends have a normal debit balance, so to close them out, we're going to need to credit them. So I'm just looking at the revenue, the income statement, and seeing the dividends to know what we need to close out. December 31st, We debit service revenue because we debit it to zero it out. Since it has a normal credit balance, we debit service revenue $68,500 to zero it, and we credit retained earnings of $68,500. The various expenses have normal debit balances, so we are going to credit all of those to zero them out. We're going to total them and put one sum of $55,800 into a debit to retained earnings. Then, to zero out our dividends, which has a normal debit balance, we are going to credit dividends of $4,200 and debit that into retained earnings. So the key here is they're showing us these financial statements. They're saying, okay, prepare closing entries based on this. Well, we know anything on the income statement needs to get zeroed out, and dividends need to be zeroed out. So they're showing us these financial statements to go, okay, I need to know what are temporary accounts, so I zero them. Now, the next thing it asks us to do is to prepare a post-closing trial balance. Guys, remember, a post-closing trial balance only has assets, liabilities, and stockholders' equity. So the post-closing trial balance is going to be a debit to cash of $2,900, a debit to accounts receivable of $5,400, a debit to land of $82,000, accounts payable credit $5,100, common stock credit of $54,000, retained earnings credit of $31,200. So that's it. The post-closing trial balance is just merely the balance sheet. It's that straightforward. Now, I'm going to take 2 minutes and just stop this recording so I can get it posted so I can start again. Okay, on number 2, we credit all the expenses, correct, and we debit our retained earnings.